Hi guys, welcome to another video by Optionables. My name is Saket, and in this video we are going to talk about adjusting the trades. So adjustment is something really important, and many people have been asking us about how to adjust a particular position if it's going under loss. So in this video we are going to talk about two simple ways of adjusting the position. Trust me, there are multiple ways to adjust a single position, but what we are going to show in this video is only how you can adjust intraday short straddles as well as short strangles. So I'm going to teach you two simple ways to adjust that particular thing. And most important thing, before learning how to adjust, we will also understand why it is important to adjust and what is the main reason behind adjusting a particular trade. So that is really important to understand. First we'll understand that, and then we will move towards learning the adjustments. So if you haven't watched the video on short straddle as well as short strangle, please check the link in the description to watch the video, so you will exactly understand what we will be talking about. So these are two simple ways to adjust the intraday trades, that is the short straddle and short strangle, and I hope you guys like this video. So a simple thing why adjustments is so important. So yesterday, that is expiry day, so we still haven't made a video on that. We'll be making it tomorrow and posting it. So yesterday, if you saw our trade log, we had so many positions open, right? So if not for these adjustments, trust me, yesterday we ended with only a 8,000 rupee profit, but if not for these adjustments, our loss would be somewhere close to 2.5-3 lakh. Just because we did these adjustments, we were able to come back to a profit of 8,000 rupees. So I am going to explain in tomorrow's video how exactly we use the adjustments that you will be learning today in this video, and I hope you guys like this. And do not forget to watch tomorrow's video, because whatever you will be learning today, I'll be showing how exactly that has been used tomorrow. So that will be really important for you to watch that video as well, because you will be seeing how these adjustments are used practically in actual trade. Hello everyone, welcome to this video on trade adjustments. So before we start adjusting, it is very important for us to know why we should adjust. So why do you want to adjust a trade? So is the idea to come to profits? Is the idea to reduce the risk? What is the entire goal of adjusting? First, the most important question, why adjust? So now let's say I have a strategy where strategy 1. So let's say this has a win rate of 70%. So if I am taking 100 trades, let's say this has a win rate of 70%, which means 70% I am going to win, 30% I am going to lose, 30 trades I am going to lose. Let's say my average risk to reward is also 1:1. So which means, let's say if I win, I am going to get 5,000 rupees average profit, and the average loss is also rupees 5,000. So now if I take 100 trades, I am going to make 70 into 5,000, because this is the average profit I am winning, or the average profit I make when I get the trades, right? So which is 3,50,000 minus 30 into average 5,000 is my loss. So I am going to lose 5,000 rupees 30 times, which is 1.5 lakh. So my net profit is going to be 2 lakh rupees if I take the same trade for almost 100 times. So I hope this is clear. So what we have done here is basically we have seen what is the probability of winning, that is 70%, and the risk to reward is 1:1. So let's assume it's 5,000 if you win. The average profit is 5,000 when you're right. The average loss is 5,000 when you're wrong. So when we win 70 times, we are going to make 3,50,000 rupees. And when we are going to lose 30 times into the average loss, which is 1,50,000 rupees. So net we are going to make 2 lakh rupees. So now what is the point of adjusting? So I will tell you what is the point of adjusting. It is never about making huge profits. So there's a very important thing what you have to understand. Adjusting is not about making huge profits. It is only about managing your risk well. So now imagine I am going to make the same thing. Let's say you have 100 trades. So this is your second trade, 100 trades. When you're adjusting, right, your profit as well as loss is going to come down. So you can't be having same amount of profits also. So your profit and loss both are going to relatively fall. So let's assume that you have the same probability, or let's decrease the probability also. Let's say you have a probability of only 68 times, so 68%, and you are going to lose 32%. But when you're winning 68 times, if you win say an average of rupees 4,500, and let's say remaining 32 times while you're losing, you only end up losing 2,500. So this is the entire point of adjusting. So even though your probability reduces, even though your average profit reduces, your average loss is going to come down much more. So we will see what exactly happens with this. So when you make 4,568% of the time, so 68 times out of 100, you are going to get 3,06,000. So you're going to get a positive 3,06,000. And when you're going to lose 2,532 times, that is going to become 80,000. So now what is your net? Your net is positive 2,26,000. So you can see that with adjustments, even though you have reduced your profit, even though you have reduced your probability, you're still at a better off position after taking 100 trades. So this is really important for us to understand why we should adjust. So you can see that you have increased your net profits by almost 26,000, or almost close to 13%. So this is the entire point of adjusting, that is to curtain your losses small. So to cut down your losses small, so when you are making profit, it is going to add up to a huge sum later on. So you can see here from your previous trade, you have cut down on probability, you have cut down on profits, but the losses, average loss has also been cut down to 2,500 instead of 5,000. So by doing this, you can make much higher profits in the longer run. So I hope it is clear why exactly you're adjusting. So don't go with a notion that when you adjust, you can never end in loss. So that is not the point of adjusting. But what is the constraint? All of us have limited capital. So we can't keep adjusting forever. So it is really important to understand what is the point of adjusting when we have limited capital. And trust me, if you have unlimited capital, you can never end in loss. Whatever you do, you will always come out with a profit. Okay guys, next we move on to some very important points that we have to make a note of before we start adjusting. Whatever we are learning, use it on the intraday trading systems only. So whatever we have learned about short straddle, use it on that alone. So don't use it on anything else. And if you are not aware of what is the intraday trading system that we have built, please watch the short straddles as well as short strangle videos from link in description. So if you see the description of the video, you will find two links, one for short straddle, one for short strangle, and we are talking about adjustments for that particular thing only. And do not use this on positional trades, because the way you adjust positional trades is completely different, and we are not talking about adjustments of positional trade. So these three are major points that you have to keep note of. There are multiple ways to adjust. So we are only talking about adjusting an intraday trade. Do not use it for positional trades. So with these points being clear, we will quickly move on to our first adjustment. So I'll be showing you two types of how you can adjust the particular position. The first adjustment type is known as counter. Note that you're using the counter only if one position triggers the stop loss. So counter is only used when one position triggers the stop loss. Only then use this particular adjustment. So you must be already aware of this adjustment if you're following our intraday trades every day. So I'll explain what exactly this counter is and how we are going to use it. Let's say you do a short straddle, say 35,000 calls and puts. You do a short straddle at 500 rupees each. So you have shorted calls at 500 rupees, puts at 500 rupees. Now let's assume that you place a 30% stop loss, and your stop loss is at 650 rupees. So this is at 650 rupees and this is at 650 rupees. And let's assume the market was trading like this, and suddenly the market comes down and your PE stop loss is triggered. So now let's see what happens. So when your PE stop loss triggers, right? So the call option which you have shorted will be somewhere around 370 rupees, and the put option would have triggered the stop loss at 650 rupees. So which means how much have you lost? So from this particular thing you lost 150 rupees, minus 150 rupees. From your call leg you have gained 130 rupees. I hope this is clear. So your PE leg hits the stop loss. If your PE leg hits the stop loss at 650 rupees, your CE will be somewhere around 370 rupees, which would have given you 130 rupees profit, and this would have given you 150 rupees loss. So your net loss is going to be rupees 20. So here comes the adjustment part. So if you feel the market trend is going to continue downwards, then don't do anything in a hurry. Wait for some time till this PE premium becomes 330 or 320. So if you feel the market is going to come down even more, don't do anything. So it is really important to understand, because adjustments don't have a rule book. So it is completely discretionary when you adjust and how you adjust. If you feel the trend is going to continue, you might use any technique you want. Use technical analysis, use open interest. If you feel the trend is going to continue, don't do anything right away. So wait for some time. Because if the trend continues, then you are anyways going to come to profits. So there is absolutely no need to do adjustment. So now we will discuss what happens if you feel that the trend might not continue, there might be a reversal, or the market might consolidate there. You have sold your call option and put option at 500 each, and this has triggered the stop loss at 650 rupees. Which means you are at a loss of 150 rupees right now, and this is currently trading at 370 rupees. So which means you are at a profit of plus 130 points. So how are you going to adjust this position? You have sold 35,000 straddle. I don't know which option will be trading around this range. So you have to pick an option which is less than half of this price. So if this is at 370, then pick an option which is currently trading at 160 or 150. So pick an option which is trading at 150, and that must be the put option. So don't pick the call option. So you are going to short an option which is trading less than half the price of CE. So even if you go say around less than 60% the price of CE, that is absolutely fine. So go to an option which is trading between the range of 120 to 150. So you have to select a put option trading in the range of 120 to 150. So let us assume 33,500 PE is trading around the range of 150. So you are going to short this one option. So if the market continues to move down in the same direction, so then what is going to happen is this 150 is going to become somewhere say around 230, whereas this 370 rupee option is also going to become rupees 230. So which means what has happened? So this you have lost minus 70 rupees. From this you have gained plus 140 rupees. So totally, let's understand what has happened. First you gained 130 rupees, and from the put leg you have lost 150 rupees. From this particular short leg you have lost 70 rupees, and further you have gained another 140 rupees from this particular leg. So overall you are going to come to profit. So 130 plus 140, 150 minus 70. So you are going to come to an overall profit of rupees 50. So this is one way of adjusting the position. So now you see that, okay, the market has moved in the same direction. You're making small profit. Instead of making a huge profit, you're making a small profit. So then what is the use of adjusting the position? So that is what we are going to discuss now. So case 1, we saw that the market went down and we came out with a profit of rupees 50, right? So now we are going to see the case number 2, where the market consolidates in the same range. So in case number 2, so let's say the market falls down and consolidates around the same range. So one you are currently holding at 370, other one you are currently holding at 150. So if the market consolidates in the same range, due to theta decay, right? Due to theta decay, you are going to gain around 20 points from this, 20 points from this, which means this is going to end at 350. This is going to end at 130. So which means what will happen? So this has given you 20, this has given you 20. So which means what will happen? So first you gained 130 rupees, lost 150 rupees. Now you have gained plus 20, plus 20. So overall you come to a profit of rupees 20. So if the market consolidates, you're again going to make 20 points profit. So now we are going to take the third case where the market bounces back. So third case where the market bounces back. So first case is where we made 50 rupees if the market continues falling down. Second case is where the market consolidates and we made positive 20 rupees. And third case, if the market bounces back. So let's say the market bounces back, then the option trading at say around 370 ends up becoming, let's say, around 450, right? And option trading at 150 rupees will end up becoming somewhere close to 80 rupees. So how has this happened? There's going to be theta decay on both the sides. So even though this might end up becoming 470, 480 initially, but due to theta decay, it is going to come back to 450. And theta decay is going to happen on this leg also. So how much have you lost? So here you have lost minus 80 rupees, whereas here you have gained somewhere close to 70 rupees. So what happened total? So total you had a negative of 150 rupees, then you gained 130 rupees, and now you have negative 80 plus 70. So your net loss is only going to be 30 rupees. So net loss is only going to be rupees 30. So otherwise, how much would have been your net loss? Your net loss would have been, here you have already lost 130 rupees. So if you had not done the adjustment, we will see how much would be your net loss. So if you had not done the adjustment, you would have lost this 70 entire rupees, which means you wouldn't be having this. So you would have a total loss of 110. So that is the reason making small adjustments make a huge difference over time. And just now we saw why making this adjustment was so fruitful. So when the market continued in the same direction, you had 150. You had a 50 rupee gain. When the market consolidated, you had a 20 rupee gain. Whereas the market, when it bounced back, you just had a 30 rupee loss. So this is where it is going to help you a lot. So small adjustments are going to make a lot of difference. So this is the first way to adjust the position, that is called as counter. Hi guys, so we have already learned about an adjustment called as counter. Next we'll be learning something about shifting. So one very important thing what you have to learn from this is it is completely discretionary as to when do you want to do the adjustments. So there is no rule book saying at this point you are going to make the adjustment. So in case of the first adjustment, that is the counter, there you are going to adjust the position when you feel like doing it. So if you feel the market is going to go down and you have a call option short, don't do it. If you feel the market is going to stabilize or bounce back, then try doing it. So it completely depends on an individual when exactly he must do the adjustment. And second thing is something called as shifting, which we'll be discussing about right after this. So even there, the most important thing is to know when exactly do you want to do it, or how sure are you that this thing will happen, so you want to do the adjustment. So this is really important, and also this is only for educational purpose, where I am teaching you two adjustments, two ways to adjust. So there are multiple ways to adjust many other positions. So these are two ideal ways to adjust your intraday trading system positions only, and it is completely discretionary. Again, I am mentioning, please do proper research and try to understand the markets well, and then only adjust your positions. So if you are not able to understand the markets well, or if you are not able to adjust the positions well, then you don't have to adjust, just stick on to the proper trading systems only, because trading systems will anyways give you good result. So if you are comfortable doing the adjustments, only then do it. Otherwise you don't have to do it. It is completely optional. So next we come to something called as shift. So first we saw counter when the stop loss gets triggered. Shift is an adjustment when you do when your stop loss is not triggered. So keep this in mind. When your stop loss is not triggered, you are going to do something called as shift. So I will explain with the help of a strangle, because we already discussed straddle. So I'll explain how you can do it with a strangle. Same way you can do it with the straddle also. So there's no change in the fundamentals of the adjustment. It is going to remain the same for straddle as well as strangle. So let's say Bank Nifty is trading around 35,000. You do a 34,700 and 35,300 short strangle. So this is PE, this is CE. So let's say you did this at say 400 and this at 400. Okay, and we will assume that you have placed the stop loss at rupees 650. So it's a big assumption that you have placed a very big stop loss at rupees 650. So I am going to tell you how exactly you can adjust your position now. So let's say the market consolidates and suddenly there is a big fall, right? This call option, which is trading at 400 rupees, would have become 300 rupees. So this will be your call. So which would have given you a 100-point gain. So I hope you are clear how 100 points. So you have shorted at 400 rupees. So this is into -1 and this is into -1. So you have shorted at 400 rupees. Your call option is currently at 300 rupees, giving you a gain of 100 rupees. This put option, which you have shorted at 400, will be somewhere around 520 rupees, giving you a net loss of 120 rupees. So what is your overall loss? So it is going to be somewhere around 20 rupees. So now how are you going to adjust this position? So this is when you do something called a shift. So you can see that your stop loss is not yet triggered, but there is a huge imbalance in premium. One is at 300, one is at 520. So there's a huge imbalance in premium, and that is what you are going to adjust now. So I'm just going to clear this and we are going to come back from there. So we have a call option which is currently trading at 300 rupees, and we have a put option which is currently trading at 520 rupees, and we have placed the stop loss for both at 650 rupees. We had shorted both at rupees 400 and 400. So this is our BEP. So we are at a net loss of 20 rupees. So net loss 20 rupees. So I hope this is clear. So now what you are going to do is you are going to exit this call option. Let's assume another 100-point move, right? So this option is going to go to 570. This will only fall to 260. So another 100-point move, this option will trigger the stop loss. This will only fall to 230. So you can see here what is happening. This option, call option, is not losing premium as fast as this put option gaining premium. So that's the reason you have to bring some balance. And how are you going to do that? Exit this call option. Now short another call option trading somewhere around the range of 400. So now you have booked 100 rupees from this particular call option, positive 100 rupees. You have booked 100 rupees from this call option. Now you are shorting one more call option. So exit this position, don't hold this position, exit this position. Now you are shorting one more call option trading at 400 rupees. Right? And now you have another put option trading at 520 rupees. So why is this so important? Don't balance the position at any cost. Don't go and short another option trading at 520 rupees. Why? Because if the market reverses, then you are going to fall into a huge trouble. You should always have some room for reversal. Don't balance the position exact to exact, because if the market, let's say, would have come down this way, it would be trading here, it would have come down here, right? If you exactly balance it at 520, and what if the market comes back up here, you're again going to lose. So one, unless there's some big imbalance, do not adjust the position. So if it is somewhere, let's say 350, 480, don't adjust the position. Or if it's say 320, 490, don't adjust the position unless there is some big imbalance. And when there is an imbalance, then don't adjust the position such that the calls and puts become equal. So make sure that the call option is little lesser than the put option, or in case if the market goes up, then the put option is little lesser than the call option. So there is always room for reversal. So room for reversal. So you are at a net loss of 20, and I hope this is clear. So we are going to consider positions from here. So case number 1. continues in the same direction. The put option, which is trading at 520 rupees, will continue to gain and become 600 rupees, and the call option, which you have shorted at 400 rupees, will end up becoming 320 rupees. So you can see that why I have considered a 80 point gain here and a 80 point loss here is because there will be some effect of theta also happening on this particular option, both the options. So there will be some effect of theta on this, some effect on theta on this. So that's the reason you started with a net loss of minus 20. And so let us assume this goes to 325, not exactly to 320. So this will give you a gain of 75 and this will give you a loss of 80. So which means you have net lost 25 points only. So what if you had not done this? The other one might have only lost 60 rupees. So in that case, you would your loss would have been 40 rupees, which you have cut it down to 25 rupees. So with this, your loss, if the move continues on the downside, gets restricted to minus 25. So we'll take case number 2 where the market consolidates. In that case, there will be theta decay on both the sides. Let's say this 520 will end up becoming 500 rupees and this 400 rupees will end up becoming 380 rupees. So you have already had a net loss of 20 rupees. You have gained 20 from here, you have gained 20 from here. So you will end with a positive 20. So which means if the market consolidates, you have a positive 20. And finally, the last case is when the market reverses. So in this case, what happens is if the market starts heading back up high, so this at 520 will end up becoming somewhere close to 430 rupees. And this which you have shorted at 400 rupees will end up becoming 470 rupees. So on top of this, there will be some amount of theta happening. So let's assume this will end up at 420 because of theta and this will end up at 460 because of theta. So theta decay will happen on all the options, and that's the reason you have assumed there will be some amount of theta decay happening on top of loss of premium. So now what will happen? So this option you gained 100 rupees, this option you lost 60 rupees, and you had already lost 20 rupees in the beginning before the adjustment. So you are at a net profit of 20 rupees. So which means case number 3, when the market reverses, you will come to a profit of 20 rupees. So you can see that with adjustment, you are reducing both your profits as well as losses. But the most important thing is you are cutting down on your loss. And this is really important. So there is one important thing. Do watch Thursday's expiry date trade at which we will be posting tomorrow, because you will exactly understand because of the shifting how much money we have saved. So if not for shifting, we would have lost in lakhs, and because of shifting, we didn't end up losing anything. We were actually at a net profit just because of shifting. And I'm going to show you in tomorrow's trade how exactly we did shifting and how exactly we could come out with a profit, because it is really important to understand, because this small adjustment will actually not just help you restrict your losses, but sometimes also go to net positive, and we'll be discussing that tomorrow. And finally, if you are liking the content on this channel, please do hit the like button, because it will encourage us to do more such content. Thank you so much, guys.